Hello. Welcome to the next installment of the Foster Swift Going Forward webinar series. Today's topic is the PPP loan forgiveness form is out. Next steps to planning to ensure forgiveness of your PPP loan. I'm Mindy Johnson, an attorney and co-leader of the business tax group at Foster Swift. Joining me again today are two of the attorneys from our group, Michael Zahrt and Taylor Gast. You may remember Mike and Taylor from their prior webinar on planning to ensure forgiveness of your PPP loan. We were very pleased with the interest and questions that were generated from that webinar. And so we want to emphasize at the beginning of today's broadcast that the advice that Mike and Taylor are going to give is just general advice. We always recommend that you consult with your own attorney with regard to how these rules apply to your unique situation. Before we get started, I want to remind you of just two housekeeping items. The first is that this webinar will be recorded today, and a link to that recording will be emailed to all attendees. Additionally, that link will be posted to the Foster Swift website on the coronavirus resource page. Second, Mike and Taylor do plan to present their materials first and answer questions at the end, time permitting. We have enabled the question and answer feature for you to use to convey your questions to Mike and Taylor. They will do their best to answer them in the time that we have today. But please remember that you're always welcome to reach out to one of them after today's webinar to follow up on any questions that remain unanswered. So with that, let's get started. Mike, the floor is yours.
Thanks, Mindy. Thanks everyone for your continued interest in this webinar series. We've just been amazed by the response and the subscription to these. It's wonderful. We are happy to provide the opportunity to help out. So if you're attending this webinar, you probably already know that the SBA has released the PPP loan forgiveness application. It's large. It's 11 pages, and you fill it out backwards. I wish that were a joke. It's not. So we'll go through that today. It's a little difficultly worded, but this is going to be a little different than the format of our webinar last time. The application did not come out with a set of new interim final rules. There were no new FAQs. It was, I think, surprising to both of us that they did it that way, because some of the rules that are set forth in the application are sometimes inconsistent with the CARES Act. So we are treating this application as though it has the force of law, like it's foreshadowing rules that we will hopefully get in the near future. Keep in mind, though, that on the front end of this, they did change the PPP eligibility application at least once before that was finalized. So it's not outside the realm of possibility that they will change this one too. So for the folks who attended 2 weeks ago and are back again, thank you for that. We're going to go through this kind of in the way that we would recommend that you fill out the application. We're going to be working backwards through it. So you have the actual application. To fill that out, you need to complete a Schedule A, and to fill Schedule A out, you need to complete the worksheet to Schedule A. So that's why you kind of got to work backwards, and that's the way that we're going to present this. I originally wanted to do this as like a case study with a sample company, and there's just so much new stuff in this application that 50 minutes, an hour really didn't give us enough time to do that. So we're going to be highlighting what's new, what you need to know. We'll be going through some of the reduction calculations, but this is going to be a different format than last time. For the people who did not attend 2 weeks ago, we don't want you to be too concerned that you're going to be missing out on stuff. In fact, we can go to the next slide here, and we'll give you just the quick recap on what we did last time. And just as a housekeeping matter, we do see the Q&A and the chat down below there. Please keep populating that. We got a bunch to get through, more slides than last time, so we're going to try to plow through this, save some time for questions at the end. Same drill as last time. We've got a hard cutoff at 11:15, so we'll try to save some time to get through your questions. But just to recap from last time, so last time's webinar and this one is going to be working under the assumption that you want your entire PPP loan forgiven and how to go about accomplishing that. It's not the end of the world if you don't accomplish that. I mean, your options are to keep it as a really cheap line of credit. It's 1% interest over 2 years, so not the end of the world if you don't use the whole thing. It's also got a 6-month deferral window. You can prepay without penalties. So, I mean, if you get to the end, you got some left over and want to give it back, you can do that too. So it's not the end of the world if you don't use the whole thing, but this webinar is going to present the rules in the context of, you know, I've got my PPP loan, I'm forecasting out to achieve full forgiveness of the loan. So what's that look like? We've got 5 things here. First, we have to satisfy the eligibility rules and certification requirements. 2 weeks ago, this was a much bigger issue. Since then, we have a new FAQ from Treasury that essentially indicates that if you've got a loan under $2 million, you're going to be deemed to have made that certification that the loan is necessary to continue business operations in good faith. We think it's reasonable to interpret that as you're not going to be audited, or at least your audit risk is substantially lower than we thought it might be 2 weeks ago. For those of you who are over that $2 million threshold, there is a box to check on the application where you are essentially self-reporting. So yeah, requirement 1, you're eligible and can meet the certification requirements. Requirement 2, you have to spend all of the loan proceeds during the 8-week period. This is what I just talked about. We're assuming you want the whole thing forgiven. In order to get it all forgiven, you have to spend it all in the 8-week window of your covered period. There has been some chatter both from the Secretary of Treasury and several congressmen that we want to extend this 8-week window. I mean, you know, part of this is like, you know, I was looking through this application. I was looking for, like, you know, secret GPS coordinates to the time machine that takes me back to when this stuff's actually helpful, right? Because we've got some clients that were quick to apply, and they're in week like 5, maybe week 6 of the 8-week covered period. So you can still do some corrections and forecasting, but I mean, you know, if you were early on this, you don't have a ton of time left. And as things stand right now, it's still a firm 8-week period to spend all the money. There's chatter about extending that, and that's risk appetite, right? Do I want to hold on to the money hoping they extend it out? And if they don't, that's a loan instead of free money. You know, just be aware of that. Right now, it's still a firm 8 weeks, regardless of, you know, what you might see on the news. Okay, other requirements. You have to retain your employees compared to pre-COVID-19 numbers, and you cannot reduce their wages by more than 25%. These bullet points reflect the employee census test and wage reduction test. The application provided us formulas for how those work, so we're going to go through those today. And this last one, you have to spend at least 75% of loan proceeds on payroll costs. This is another area where we got some clarification. We'll go through that in a little more detail later as well. But again, if your goal is to get the entire amount of your PPP loan forgiven, you need to spend 75% of that on payroll costs. So that is the extremely abbreviated summary of what we talked about for an hour 2 weeks ago. With that, I'm going to turn it over to Taylor, and he's going to talk about what's new in the last 2 weeks.
Thanks, Mike. Morning, everybody. So yeah, we received the application and we wanted to kind of set the stage here and pull out the kind of big updates and you know, more significant changes and updates and clarifications as we see them. And so that'll be this slide, and then we're gonna kind of start diving into those after this. So, you know, going down the line here, we have the alternative payroll covered period, or the APCP, or if you hear us say alternative period or something along those lines, that's what we're talking about here. And you know, we'll probably be kind of diving in a little more deeply on this as we go through, but you know, the basic idea here is you know, you can elect to take the you know, either your 8-week period to judge your payroll costs, or you can, and with that 8-week period beginning on the day that the loan funds were deposited, or you can elect the alternative period, the APCP, as we may or may not be calling it. I don't know, I might stumble over that one. And in any case, whatever we're calling it, if you elect it, you start the clock on the date that the your first payroll is run. You include that payroll, and then you go out 8 weeks after that, and you're able to use any payroll that's within those 8 weeks. And so, you know, we had all sorts of questions. I'd say maybe the number one question that I received before and after the last webinar, just in terms of frequency, has been timing and the 8-week period and how does it work. And we have any choices? And under the old rules, there were no choices. It was 8 weeks, hard begin, hard end, based on the date that the loan was deposited. And it's still based on that date for the most part, with some clarification that we'll talk about in here. But we now have the alternative period. And so that, I think there's certainly some strategic decisions to be made here, some planning, and some thinking we want to do about that. And that's a real kind of top line, potentially very helpful in a lot of cases, update that's kind of baked into the application here. Another big one that also relates to timing is paid or incurred expenses are now permitted rather than paid and incurred. And I think we'll dig into that in a moment, just actually on the next slide. So I'm going to cover that in a second here. If you attended our last webinar, you know that there was some kind of ambiguity surrounding the 75% test. The 75% test being that at least 75% of the loan must be used on payroll costs, and up to 25%, no more than 25% should be on non-payroll costs. And ambiguity as to the effect of not reaching that number. And again, we'll dive into that, but it's a little bit more forgiving. It's not all or nothing. It's not, we're looking at potentially big consequences if we don't hit that number. It's really a loan forgiveness reduction formula for the most part here, but still something to keep in mind. We now also have the loan forgiveness reduction formulas. We kind of, for lack of a better term, called them test 1 and test 2, and we're going to continue to sort of track that language, but you'll recall that those are, as Mike mentioned, related to payroll and whether we've reduced salary and payroll, and also our head count and census as it relates to full-time equivalents. And we have those actual formulas now. I'd say in general, those track for the most part what we've talked about before, with a whole heaping load of clarification on top of it. So we're going to add some complexity here, try and keep it as easy as we can, but there's only so much we can do and they kind of pile rules on top of us, but we'll talk about those. We also have new safe harbors, some of which I would say are generally pretty helpful. We have some planning that we can do here, and if we haven't been able to plan, like Mike said, and we're reaching the end of our window, or the facts are what the facts are as we're getting to the end, some of these may be able to give us a little leeway and potentially avoid some significant hits to our loan forgiveness, and we'll detail those. We also have this, audit self-reporting concept and the 56-day covered period. We'll dig into those, so I don't want to, cover them, too much at length. And I think the 56-day we actually we've kind of hit on. There's really no choice as it relates to our loan forgiveness window, other than, again, going back to that alternate period. I think that'll cover it on this slide, and we'll move on to the next here. This cost tracking, I'd say this is some of the bigger, more helpful, borrower-friendly, frankly, updates that we have. Previously there was some confusion and question and really, looking at the rules and thinking, can this really be the rule? We're trying to provide 8 weeks. It seems kind of odd how this is working. And now the updates here tell us that, this is actually quite a bit more friendly than we may have even thought initially. So while it previously sort of stated costs must be paid and incurred during the 8-week window in which we have to spend the loan proceeds, now we have two concepts. We have costs that are actually paid within the 8 weeks, and those are permitted. And then we also have costs that are incurred during the 8 weeks, and those are generally permitted. So we have a good amount of leeway to actually pull in some costs that were potentially incurred before our 8-week window. So for instance, we might have a utility bill that service was provided before those 8 weeks, but we don't pay it until the 8 weeks, and that's generally permitted. And then we also have, concepts that allow us to, look at costs being incurred during the 8 weeks, but then being paid, just after. And so, that's also generally permitted and very helpful. That's going to help a lot of you guys as we're thinking through, we've had a number of clients contact us and say, I'm having a tough time using all of my loan proceeds. This is one area where we really want to think about, can we potentially, loop in a little bit more of our costs that are out there. And, there's this kind of prepayment idea. I'm jumping ahead to our third bullet there, but, are prepayments permitted? And, to an extent, the costs paid and incurred actually give us some leeway there. And then we also additionally have some language in our application here that gives us at least some reason to believe that maybe prepayments are permitted. I think it's something that we want to think through and talk about as to how aggressive we want to be on these decisions. It's not an absolute yes. We are in a little bit of a gray area on this. So we don't want to tell everybody that you absolutely can make prepayments. But for instance, the application says that mortgage interest cannot be prepaid. That much is clear, but doesn't give the same clarification on some of our other costs that are out there. So the inference is that maybe it is permitted, and let's have that conversation. Let's walk through that decision before we make it and get kind of aggressive out there. But something to think about. I talked through that alternate period, the alternate payroll covered period on number 2 there, our second bullet point. So I won't belabor it here, but that is certainly a strategic decision as well, particularly for our borrowers who are ramping up. And in the beginning of that 8-week period, we're ramping up. We'll think through that and find, that there is probably a benefit to electing the alternate period, depending on how the dates fall and how our numbers work. And this is just one area that it's going to be tough to generalize and give everybody a hard and fast rule, but many, many borrowers are going to find a lot of help in electing the covered period, the alternate covered period. And, last item here, no double dipping. I mean, that's probably pretty obvious. And if you've looked through the application, you've seen the statement, but we just want to make sure that we're not, asking for forgivable costs that we've paid twice or are somehow double dipping on that. So if you have any questions or concerns about that, be careful and again, let us know.
Yeah, to me on that one, Taylor, it's more of a affirmation about this paid or incurred concept, right? Because it's, especially where you have payroll periods that clearly fall entirely within either the covered period or the alternative covered period, you're going to pay those people on a check date that's later than the payroll period date, right? So you don't get to count all of the wages that they incur through the pay period and then also count the check that you cut them when you pay it, because that would be double dipping. So that's what they're getting at, I think, in the application there. But I think it also clarifies the or, right? They changed the conjunction. It wasn't and in the statute. Now it's an or. And I would feel pretty confident about, that pay period that ended right before your 8-week covered period started, right? So I have a client whose pay period went from, I think it was April 6th to 20th or something like that. And they received their PPP loan on the 22nd and they cut checks on the 24th. They said, well, what do I do about that? I think you've got pretty good basis here in the language to include that because it was paid during the covered period, even though the actual hours that employees worked to incur that cost predated the covered period. We've got the or conjunction now. So I think that you can count that, which makes it at least conceptually possible that you could get 5 pay periods in here, or at least 4 and some change, right? Because you get all the ones that you pay. So you're probably going to pay at least 3 pay periods during that covered period. And then for that last payroll cost, you can do the incurred rule, right? So you just go day by day. What do people incur during each day? Hourly wage times hours worked, or annualize the salary on a daily basis. And you get to include all of that too. So it's really a borrower-friendly rule.
Yes, absolutely. I would say I think the common theme here is actually going to be that, again, and Mike mentioned this kind of early on, we've tried to look through this and summarize the rules for everybody, relatively conservatively, to be honest. And we've been, I think, trying to be really clear on that so that you guys have a baseline to project out and know that these are kind of the baseline rules, that if there's no clarification and I'm following a relatively conservative kind of track on this, I know what, my least risky position is. And I know what the safe options are on my loan forgiveness application. And now the nice thing is, for all of our, all of our clients and everybody who's been watching the webinars here, they've started from a position where we have a nice conservative baseline and we're projecting it accurately. And now we're kind of opening things up and we have some borrower friendly clarifications that are great. And so we're going to move in a positive direction here and have some helpful guidance as things go along here for the most part, rather than having relied on maybe more aggressive rules or hoping that we get clarification in one direction or another, and maybe that doesn't come. So in any case, yes, definitely borrower friendly. So moving on here, so first, here's our first, I think, maybe most practical suggestion, and Mike kind of alluded to it early on, but let's work through this thing backwards. It maybe isn't the most intuitive thing to do. It might not be the most obvious thing to do as you read through the application for the first time. But if you take a look and look closely through the application, you'll find that Schedule A, which is nearing the end of the application itself, is going to be the place where you want to start. It's going to give you the math that you need to fill out the rest of the form. And it's also going to be probably the most helpful for our borrowers who are still kind of in the projection stage of the 8-week window. And that's most, I would say, that's the vast majority. There are certainly those who received the loan proceeds very early on in the window, and are coming right up against the last couple weeks here. And for those, maybe we don't need to spend too much time in a forward-looking way, but there might be some decisions that we can make at the end here. And I think that's going to be our most crucial couple weeks. Those last 2 weeks of the 8 really important weeks to be sure that you've got a firm legal footing on the costs that you're going to be including on our application, and have a good sense of what our loan forgiveness picture looks like. So in any case, we want to really strongly recommend that you actually start at the back of this thing with Schedule A. And so we've pasted in the Schedule A worksheet, being sort of the place where we recommend starting. And so there's, we're going to mention kind of 4 different items here as to the most useful and kind of big things that we need to do here. Number 1 being, calculate the loan forgiveness reduction formulas. And we're going to walk through those being kind of the average full-time equivalent employees, and also the hourly wage reduction, hourly wage and salary reduction formula. So that's number 1. We also need to identify which employees we're going to be including here, and the big questions that have come up pretty frequently on some of these items have been, do I really need to include sort of one-to-one actual employee information when I add this up? And now we've been recommending, yes, that much is fairly clear under the CARES Act, and now Schedule A, the worksheet, pretty clearly clarifies that as well, because we've got these tables, and you're going to have to insert actual employees, and that's just kind of the fact of the matter. And in fact, you'll have to include an identifier that includes sort of their the last 4 digits of their social security numbers. So this is very much a specific calculation, and we'll need to include those. note that you will not be including your independent contractors, your owner employees, your self-employed individuals, and partners on these, however. And then we're also going to separate out number 3 of, in terms of our 4 things that we're going to do here. Number 3 would be that we're going to separate out employees that are relatively highly compensated. And if you can see table 2 on the bottom left there, sorry for the smaller type, but we're trying to fit everything in here. The table 2, we're going to set aside anybody who during any 2019 pay period earned on an annualized basis more than $100,000. So that's a mouthful, but the idea here is an interesting nuance where if we're reading the rule, the language seems to tell us that if anyone in any one pay period they earned on an annualized rate, over $100,000, they're in this sort of set them aside box, which is very helpful because we set them totally aside on some of our forgiveness reduction calculations. And, it appears to say that if it's in any one pay period, and so for instance, if they received a bonus, if they received, some sort of hazard pay that we're now talking about, but in 2019, or, for one reason or another, they were working a lot and they received, significant overtime, whatever that might be that adds them up beyond $100,000, we're setting them aside. And that could be a pretty useful application for a lot of our clients and a lot of you guys listening. So something else to keep in mind. Moving along here, the last item that we're going to be looking at on this, Schedule A worksheet here is entering the actual cash compensation for each employee, which, cash compensation, we just want to be real clear and think through what that includes. Of course, that's our salary and wages. It's also going to be including those, paid leave, sick leave, vacation, those kinds of leave, separation benefits, et cetera. Cash compensation are what we're including, but it's not going to include basically anything else, other payroll costs. Certainly not, your qualified family and sick leave under the FFCRA for coronavirus reasons. And certainly not more than that $100,000 limitation. We're not including anything, and nothing is forgivable beyond that. They've given us the hard number of $15,385 during the covered period. And so it's slightly off from the, if we had kind of done the perfect math and found the exact number for, $100,000 reduced down to our 8-week window. It's somewhere around there, but with some change. And now the actual hard limitation is $15,385. Nothing beyond that can be included on our Schedule A worksheet or elsewhere for any one employee. That's our limitation. So a lot to think about. We're going to move on here and get into some of our forgiveness reduction tests with Mike, I think, here.
Yeah, I think we can cover this somewhat quickly. Not too much has changed on this rule since last time. So I guess an important thing to understand as we get into this, and even for the purpose of the Schedule A worksheet, is that when we say employee, we mean anybody who gets a W-2, subject to certain carve-outs. So if you have an owner employee that gets, like an S-Corp owner that also pulls a W-2 for their wage, we're carving them out. But anybody who gets a W-2 is an employee. So your part-time workers, your seasonal workers, your interns, if you issue them a W-2, they are an employee and they count. They count for the worksheet, they count for these tests. So just because they're not around anymore or you don't really think of them as an employee, if they get a W-2, they're an employee. So I guess we'll get that right first. The mechanics we called this test 1 last time, this employee census test, and the mechanics are the same, right? So you take your FTE count during the covered period, you divide it by your FTE count during a prior period, you get to pick the period. You either get this 2019 period from February 15, 2019 to June 30th, or a 2020 period of all of January and February. So you take your covered period, or your alternative covered period, if you're electing that, divide by a prior period, and you get a quotient that's a decimal. That quotient gets entered into line 7 on the application and is used to reduce your forgiveness amount. we got an example coming up showing exactly how that works. So what's new in this loan forgiveness application? I guess the big update, a couple of them. One is this 40-hour-a-week standard. 2 weeks ago, we said you should use a 30-hour-a-week standard. I was really surprised to see a 40-hour-a-week standard because elsewhere in the CARES Act, when we talk about FTEs, it's always a 30-hour standard. So we thought that was a pretty safe assumption. It was not. It is a 40-hour-a-week standard. Mathematically, I don't know if this makes too much of a difference, right? If we're, comparing apples to apples, in the prior period, we're using a 30-hour-a-week standard, and in this period, we're using a 30-hour-a-week standard, your quotient is going to be the same, right? So if I got an employee that was working 30 hours a week, under what we were working off of 2 weeks ago, they would be 1 FTE, and if they worked the same thing during the covered period, they'd still be 1 FTE. Now they're 0.75 of an FTE and 0.75 of an FTE. When you do that quotient, you still get a result of 1. So if you're using this 30-hour-a-week standard versus 40-hour-a-week standard and people have not changed their hours, that should not impact your forecasting mathematically. Now, if you've got someone that was working 30 hours a week during the prior period, they're a 0.75 FTE, or I guess the better example is if they were working 38 hours during the prior period, they would be a 1 FTE, and that's how we were looking at it. Now, there's something less than a 1 FTE, right, using a 40-hour-a-week standard. And if you were to reduce them to 30 hours, now they're a 0.75 FTE. Whereas based on our 30-hour-a-week assumption we were using, they would be a 1 FTE no matter what. So that's where the 40 hours a week is, you're going to want to flag those people and essentially redo your forecast. That's the first big note. We have new exceptions for folks who have been terminated for cause, people who have resigned, people who have asked for a voluntary reduction in hours. The big thing to note here is that it only covers these events during the covered period. So once you get your loan proceeds or the start of your first pay period after you receive your loan proceeds, if you're using the alternative period, from there for 56 days, if you have anyone that is terminated for cause, voluntarily resigns, or voluntarily asks for a reduction of hours, you get to use their essentially old FTE number, right? You look back to the previous period that you're comparing to, whatever their FTE number was, go ahead and plug that in for your current calculation, and you're okay. We're not going to penalize you for that because it was outside of your control. So that's helpful, right? Previously, we only had this exclusion for people for whom you've reoffered employment from layoff and they rejected your offer, and we still have that too, so don't forget about that. But now we've got more categories. So again, this is a borrower-friendly revision, but it only applies to people during the covered period. So some issues we're running into that we still don't have clarification on. Say I have my 2019 period and my 2020 comparison periods. The 2019 period has a lower FTE, so that's the period that I want to use. If I have somebody that retired after 2019 but before my covered period, that's out of my control, it's going to hurt my FTE count, I don't replace them. It seems as though from a policy perspective we should carve those people out too, but we don't have that rule yet. So same advice from last time, keep track of those people. Maybe you do something with them on a planning perspective. Maybe the safe harbor helps you out, but we don't have guidance on those people yet. So the exception is only for people who leave that are outside of your control during one of your 2 choices of covered periods. We also have an update on this June 30 safe harbor. Last time we did this webinar, we said just don't even pay attention to it because we have no idea what it means. We have an idea of what it means now, and we're having an example showing you exactly how that works. And before we get into those examples, one more thing I guess we need to cover that's not on the slide is this simplified method for determining FTEs. Usually it's divided by a 40-hour work week. You get a decimal, round to the nearest tenth, either up or down if you've got hundredths, and that's your FTE. They provide a simplified method for you where if they work less than 40 hours a week, they're a 1/2 FTE. That doesn't matter if they work 39 hours a week or 1 hour a week, they are a 0.5 FTE, and anybody 40 and over is a 1 FTE. So be aware of that, and I'm telling people calculate it both ways. Use the alternative method and use the actual mathematical nearest tenth method and see which numbers are lower. Now you have to do it consistently, right? So if you use the simplified method for your prior comparison period, you have to use the simplified method for the covered period. You can't kind of pick and choose between the two. You've got to be consistent. But it might help you out, right? So if I've got people who are working 30 hours a week in the prior period, they're a 0.5, even though if I did the math, they would be, I guess let's call them 15 hours. Yeah, 30 hours a week. They're a 0.5, even though they should be a 0.75. And during the covered period, I cut their hours in half and I reduce them to 15 hours a week. Under the simplified method, they're still a 0.5 and I don't get dinged on this employee census test. So it seems like a crazy result to me that I can cut somebody's hours in half and I'm not going to get penalized at all on this test. But using the simplified method, that's the result that you get. Now it cuts both ways, right? If I've got people who are 30 FTEs, 30 hours a week, and they stay 30 hours a week during the covered period, I don't want to use the simplified method because I'm not getting the credit for that extra 0.25 FTE. So be careful, but do it both ways and you might actually get a better result. Okay, so that's the update. Let's look at it in an example. So let's say I have a $100,000 PPP loan. And just to make the math easy, let's say during the 2019 period and the 2020 comparison period, I've got these employees. I've got A through G who are my employees, and here's what they work, right? So if we do the math in the kind of column on the left here, we apply a 40-hour-a-week standard, and I can see that even though Al works more than 50 hours a week, he's capped at 1 FTE. Doing the math, that gets me to 6.2 FTEs for the prior comparison period. And during the covered period, I've got to knock people's hours down. So Al's down to 45 hours. I lay off Frank and George because I don't have enough work. Doing the math on these on a 40-hour-a-week standard, using the true standard, not the simplified standard, we get to 3.6 FTEs for the covered period. So that's my FTE quotient is 3.6 divided by 6.2. That gets me a quotient of 0.58. That's what goes on line 7. But applying this to the forgiveness test then, we see that our new maximum forgiveness amount is only $58,000. It's 58% of $100,000. So we're really getting, hammered on laying off Frank and George is really what's hurting us, and knocking Carol back from 40 hours a week to 25 hours a week also hurts us on the FTE calculation. So, and that's exactly what this test is designed to do, right? I mean, the whole point is protecting people's paychecks. If you lay them off during, your covered period, you're going to get dinged on this stuff. Fortunately, there is a new safe harbor. We get to understand how that works. So we got this June 30th safe harbor. And here's how it works. So we have, and this is entirely new, guys, right? So we just had this, the CARES Act said if you bring people back before June 30th and you restore their wages before June 30th, we're not going to penalize you under the reduction rules. And we just had no idea what that meant. So this puts some meat on those bones. It essentially gives us new rules too, right? So we've got the dates you want to keep in mind are February 15, and that's kind of the date Congress has picked for this is when the pandemic started. And April 26, which is 30 days after the PPP program started. And those are the 2 dates we want to keep in mind. So here's the mechanics. Step 1, step A, calculate your FTEs during this post-pandemic period, February 15 to April 26. Step 2, look at your FTEs when the pandemic started on February 15. If your FTEs are lower on February 15 than they were for the covered period, you flunk the safe harbor. If they are more than during the safe harbor period, if you laid people off because of the pandemic, you get to use the safe harbor, okay? So now that's kind of the prerequisite, right? To use the safe harbor, your FTEs during the, B's got to be more than A, right? So that's our prerequisite. If that's the case, now we go to step 2, which is looking at the FTEs as of June 30th. If they equal or exceed the folks that were FTEs at the start of the pandemic on February 15, there is no reduction in loan forgiveness. It's an incredibly powerful tool. I think there's a lot of planning opportunity here because, again, we talked about this 2 weeks ago. For the employee census test, we don't care if it's the same exact person that's working. We're just literally counting noses. We're counting hours. And it can be a different person. It can be someone who earns less pay. We just got to replace the FTE for the purposes of this test. So that's Safe Harbor 1. We're going to do an example of that next week and see how it works. What's really fascinating to me is this Safe Harbor 2 Oh, sorry, Taylor. I kind of got up there. And it's on, it's Schedule A, line 10, and there's a box you can check. And it says that, and here it is, if you have between January 1 and the end of your covered period, if you have not reduced people's, let me read it verbatim here, if you have not reduced the number of employees or the average paid hours of your employees between January 1, 2020 and the end of the covered period, check here and skip the employee census test. So there's only two ways of interpreting this, right? There's either this new safe harbor that just came out of the blue that says that if your FTEs on January 1 equal your FTEs at the end of your covered period, you're good. Skip the employee census test and you've got no reduction. Maybe. Keep an eye out for that. I'm really hesitant to give you gospel on that because it seems super aggressive to me, right? The other way of reading it is to say that if you dipped any numbers of employees or any hours, if you reduce those at all between January 1 and the end of your covered period, you have to use the employee census test. I think that's much more reasonable, and I think it more closely follows Congress's intent. I think they want you using this test, but there is this alternative interpretation out there. So just beware of that. Maybe we get a rule that clarifies it. So yeah, keep that on your radar. So let's see how this, what's clearly the safe harbor, what they advertise as the safe harbor. Let's see how that works. So we're going to continue our example from previously. So we said that during our prior comparison periods, we had 6.2 FTEs, and during the covered period, we were down to 3.6. That gave us a percentage of 58%. So we were really getting hammered on this test, right? 58% forgivable instead of, the full 100. Okay, but let's look at it a little more closely. So during these prior periods, we've got 6.2, but let's say, when the pandemic starts, things start to slow down and we think we want to save some expenses. So we, start shaving some hours here and there, and our FTEs get down to 3.9. But at the beginning of the pandemic period, they weren't that bad, right? I mean, we were still kind of evaluating things and saying, well, we're gonna shave a few people, but we don't need to do layoffs yet. Things haven't really dried up. So on that date, our FTEs were 4.2. So I can use this safe harbor test. And what's really interesting to me about this illustration is that, look how much 4.2 is less than 6.2 on, on an averaging basis. And what the safe harbor test tells us is that if before June 30th, I get back up to 4.2 FTEs, there's no reduction under this employee census test, which is huge. I mean, for some of you, you've got covered periods that are going to end well before June 30th. And it seems strange to me that you can do this, but you leave people laid off during the covered period and you bring some folks back before June 30th. And as long as it's whatever the pay period was that hits, February 15, you're good. So that's huge. We're looking at, we got 3.6 employees that we've got during the covered period. So if I'm an employer and I'm planning on this and I'm forecasting, I said, well, I got 3.6, but okay, hold on, let's look back at the safe harbor. And I see that I satisfy the prerequisite to use it. I see that as of February 15, I only had 4.2 FTEs. Well, now I've only got to add another 0.6 of an FTE. So, you bring somebody on, they work 24 hours a week, you pay them minimum wage, and their job is to clean stuff, right? I mean, the CDC says you're supposed to do a better job of cleaning stuff anyway. So if I got somebody that I laid off that's making $99,000 a year, and I bring on somebody for 24 hours a week to pay minimum wage to clean stuff, I now I qualify for full loan forgiveness. I'm not going to get hammered on this employee census test because of the safe harbor. Now, what you got to keep in mind here is that even though it's conceptually possible to just lay everybody off and keep them laid off for the entire covered period, bring them all back before June 30th, and you're not going to get hammered at all on this test, you got to spend money to have it forgiven. And in the context of this webinar, we want the whole thing forgiven. So you got to spend the whole thing. So if you lay everybody off and just bring them back on June 30th, that's fine, but you're not going to be paying them. So you're not going to be incurring expenses and you're not going to be eligible for forgiveness anyway, because you're not going to be spending money. But the planning opportunity here is what you can spend it on, right? Because there's a big bucket of payroll costs. So if I am going to get hammered on this FTE rule, but I can bring somebody on at minimum wage for whatever FTE I need to satisfy the safe harbor, now I'm not going to get penalized and I have that money to spend on other payroll costs. Maybe I use it on health insurance premiums. Maybe I do take an aggressive position that I can prepay those because, well, the statute only says, or the rules only say I can't prepay mortgage interest. So maybe I can prepay everything else. Who knows? That's aggressive, but it at least gives you that planning opportunity where if I would incur that expense anyway and pay it anyway, but I'm not going to have it forgiven because I'm getting hit on the FTE test. This is a cheap way to satisfy that test, satisfy full loan forgiveness, and spend it on stuff that you would spend it on anyway. So, before we move on to this test 2 that Taylor's going to explain, I think it's worth your time to calculate your FTEs both ways. Do the precise method, use the simplified method, using a 40-hour week standard. Just for grins, calculate your February 15 to April 26 FTEs, get your snapshot FTEs as of February 15, and then all those calculations, it's a lot of work, but it gives you the picture you need to do this, creative planning, the strategic planning to make sure you're maximizing those forgiveness dollars. And maybe you can incur a little bit of costs to bring somebody back, but the benefit of that is you're really, maximizing the amount that you have forgiven. Because keep in mind here, this loan is a true loan. During your covered period, it's a liability on your balance sheet. And once it's forgiven, that moves all the way over to the other side of the column, right? Now you're in other income. So if you're thinking about your balance sheet and what that does to the shareholder equity portion, you're taking away a liability, you're adding it to equity, it essentially magnifies it by 2 in your shareholder equity portion. And that's why these forgiveness tests are important. That's why your strategic planning is important, because in terms of your bottom line owner value, these things really get magnified when you move them over from a liability to other income when they're forgiven. Anyway, that's my soapbox. I'll get out of Taylor's way here. We can move on to test 2.
No, good. That's all good. Really good information. That safe harbor, I think, is going to be really helpful for a lot of you guys. And let's think about how we're using it. But that's certainly a lot of borrower friendly updates here. So we last time around we kind of called this test 2. We're going to be a little more specific here and call it the salary wage reduction, forgiveness reduction formula here. And just, to recap, remember, we're trying to make sure both on the FTE front that we're retaining our employees or rehiring them as necessary. And then here on this calculation, we are trying to make sure, or, the intent of the rule here is to make sure that we are not reducing their wages. And the rule gives us a little bit of leeway by permitting, a reduction by no more than 25%. And to the extent that it's within that 25%, permission, we're all right. But beyond that, sort of dollar for dollar, going to, reduce our loan forgiveness. So, as it relates to specifically the application now, we have kind of step-by-step rules here. We're going to, as a first step, determine the average salary or hourly wage for each employee during the first quarter of this year. Then we're going to determine the same kind of average salary, hourly wage for your covered period, which is that 8 weeks after the loan was deposited. Or, again, we're pulling kind of back to that first idea that we have this alternative period available here. And this is where, that strategic decision and some thoughts and planning kind of comes in. Maybe we have a better outcome if we elect that alternative, which would, in general be a later, period. In any case, we're going to determine the same for whichever period we're going with, the average salary or wages. And then we're going to divide our covered period by the look back window in quarter 1. And if the result is greater than or equal to 75%, or a 0.75, then passed, and we have no loan forgiveness reduction at all. If, however, we have a result that's less than 0.75, which tells us that we've reduced wages by more than by more than 25%, then we kind of get into what the actual forgiveness reduction is going to be. And to calculate that, we multiply our first quarter wages by 0.75 and subtract, how the amount that we determined in that second step in B up there during our covered period, and multiply that by than the product that we get there. So we'll get an example here that I think will help us flesh out the numbers. But we get that, we take it from an annualized number down to our 8-week number, and we end up with sort of the reduction amount that relates to our 8 weeks of salary reduction, and that's our dollar for dollar forgiveness reduction. So let's dig into some numbers here. So we'll assume that Mike here was paid $22,500 during the first quarter, which makes his average annual salary $90,000. So we're going to annualize these numbers and then bring them back down to our 8 weeks. So on an annual basis, if we take his first quarter numbers, he's at $90,000. During the covered period, let's set aside the ACPC or the alternative period. We'll say that Mike's employer paid him $10,000, which if we, again, go back and annualize that, it averages out to $65,000. We, divide the two, we get a 0.72. So remember, we have the ability to reduce by 25%, but anything more than that is going to hit our forgiveness and result in a reduction. So since we are under that 0.75, it means we've reduced by more than 25%. And so we're going to have a forgiveness reduction. And the way we calculate that is by going back to that first quarter number, and we multiply 90,000 by 0.75, and we get $67,500. That's the maximum amount on an annualized basis that he would have been able to be reduced, or the reduced salary that he would have been able to have. And then we have that $65,000, annualized number from the covered period, which is what he was actually paid, but taken up to an annualized basis. And the difference between the two is $2,500. Now, that's again an annualized number, so we're going to bring it back down to the 8-week window. And so we have, an 8 divided by 52 is our 8 weeks out of 52 weeks number. We multiply that by the $2,500 that he's been reduced by, and we end up with $384.62. And that is going to be, the actual dollar for dollar loan reduction in this case. So, not an enormous result in this case. Of course, this is one employee. We may have many. That's also a relatively small reduction. It's a 0.72 when we, are allowed a 0.75. So not a huge result, but you may have, if you're reducing by much more than, 25%, we're going to, start to get hit quickly because we're going to aggregate all of our employees and we're going to, add those up pretty quickly. But one way that we may be able to help ourselves out here is by looking back to the safe harbor. Now that safe harbor again, that Mike initially described, helps us out here. Again, as we start to look at the salary and wage reduction, formula. So, and we're back again to those dates that Mike was really highlighting. We're back to February 15th and April 26th. And again, basic idea on the safe harbor here. We're going to, as a first step, we're going to determine our average salary or wage as of February 15th snapshot. We're going to determine the average salary or wage, and really, I think it's useful to kind of think of these as sort of separate because we have our average salaries, we have our average wages. If we have both, we're inevitably going to have to calculate those separately. But we're going to do that as a second step for the period between February 15th and April 26th. And then our next step, if that window between February 15th and April 26th is greater than or equal to the average salary on February 15th, then we do not pass the safe harbor. If, however, it's less than instead of greater than, then we, move on to D there, and we determine the salary or hourly wage as of June 30th. So we have that June 30th number again. And, if we have returned our average salaries and wages back to their sort of beginning of the pandemic levels, as of June 30th, then we have this safe harbor that says that we have no reduction. And that's, again, really helpful, allowance. There's still some lack of clarification here. I would just sort of inject a little bit of caution. We've kind of swung back and forth on a number of rules here, is how I would put this. Let's look at to step back for a second. Let's look at how the rules played out on our certification issue. We had all sorts of borrowers looking at, how do I make the certification that my loan request was necessary to support ongoing operations? And first, that seemed like a pretty easy certification to meet. And then we had, a bunch of, press and additional rules come out that said, hold on a second, we need to think about, your ability to operate and the liquidity that the company has. And public companies shouldn't be taking this at all. And those that are owned by public companies and large organizations have big issues here, and all sorts of, let's just inject all sorts of issues. And then we swung, back the other way and said that the penalties for this actually really aren't that, potentially not that big of a deal. And so we've kind of swung back and forth on how big of a, hit this is going to be. And I just want to, caution those of you guys who are, looking at the safe harbor as, I think on one call, Mike and I were sort of terming it the holy grail. It's this sort of holy grail of rules where maybe we can bring people back on June 29th and pay them and get them back on and feel good about the fact that we're within the rule. But hold on, my clarification here isn't to say we can't do that, but it feels like a bit of an aggressive approach to rehire and, restaff and put people back at their normal wages on June 29th. And I just, if we're relying on that, and particularly we're getting to the end of our loan forgiveness window right now, maybe we have other options that protect us against the possibility that new regulations come out, which we don't have and we're still expecting, that could swing us back in the other direction. That's just something to keep in mind. I don't want to throw a wet blanket on everybody here, but something just to consider, something to keep in mind. Real quick example on how we're calculating the safe harbor here. So assuming Mike's salary was $85,000 on February 15th, and from February 15th to April 26th, he was notified that he's going to have a salary reduction because times are tough at Foster Swift, and we're doing the best to tighten our belts, and so he's down to $70,000. Further reduced to 65,000 then during our covered period, our 8-week window. But Mike's doing a great job. Mike's putting together these great webinars, and maybe a little incentive is in order because Mike's just doing a great service for everybody. And so before June 30th, we're going to bump Mike back up to $85,000. Awesome. Now, if we take the safe harbor for what it seems to be saying at this point, and don't think about any clarification that could come down the line, or try and project out and protect ourselves a little bit, we'll just we think that maybe June 29th we can just bump him back up. And so even though we're bumping him back up kind of late in the game there, Mike's employer is not going to be penalized because his salary was, returned back to those February 15th numbers, even though Mike was not returned to his full Q1 salary of $90,000. This is potentially a really helpful safe harbor, and something we want to keep in mind. So I'm not going to belabor any of those points too much more here, just to say that just to rehash, but let's definitely, if we're thinking about using that safe harbor, let's talk it through and let's run the numbers for sure.
Okay, so can you guys believe it's been an hour already? I'm glad we kind of belabored those two tests because that was the biggest changes to these. I think if that's all you take away and that's all that you have time for, you've got 95% of what we wanted to cover today. So that's good. What was illuminating to me about these two rules are, one, that test 2 is almost rewritten. The way I read the statute is it looked like a take-home pay test, and you can't reduce that by more than 25%. And what it really is it's a wage reduction test. You're looking at the rate of pay, not the amount they bring home, which is interesting because you can keep their rate of pay the same but reduce their hours, and you pass test 2. And I think that makes sense because if you look at that, you're already going to get dinged on test 1 if you reduce their hours. So what these two tests are trying to accomplish to me are really two different things. One is, test 1 is protecting people from layoffs and furloughs and making sure they bring those back. And test 2 is kind of a backstop to test 1 where, okay, you bring people back, but you really throttle back their wages. And we want to make sure we're safeguarding against that too, which to me is nice because you at least aren't going to get dinged on both. Whereas our previous conceptions of these tests, it seems like you could. So just pointing that out. And also with the second test, if you're going to get aggressive on that safe harbor, at the very minimum, don't wait until June 29. Think about your substantiation rules, right? It's going to be your payroll register or reports probably, right? So, at the very minimum, I think you're going to want to bring people up to whatever your safe harbor wage is going to be at the start of the pay period. That's going to include June 30th because that's the documentation you're going to have to be providing to substantiate the safe harbor. So all of that we spent an hour just explaining the worksheet to Schedule A, not Schedule A, the worksheet to Schedule A, right? So now we got to work backwards. We hit to Schedule A. The good part is that once you do the heavy lifting on the worksheet, most of this populates for you. You pull all the information from the worksheet and it either shows up on Schedule A or the application. So that's the good news. A couple of just really high level points to hit here too. Note the $100,000 cap in cash compensation. So we previously said that on the worksheet to Schedule A, under no circumstances should you put more than $15,385 for any employer earning more than $100,000 in that cash compensation box. That's it. That's the cap. But that is cash compensation. That does not include health insurance premiums. It does not include employer matches to retirement plans. Those are all includable in the umbrella of payroll costs that are not cash compensation. And this schedule clarifies that although you have a cap on that $100,000 compensation for those employees, you can also include their healthcare premiums and their employer contributions to the retirement plan, which on a match might be pretty good if they're an over $100,000 wage earner. So that's very helpful that we can include all of those with no limit. Keep that in mind for items 6 through 8. Look also at line 9. So this is total amount paid to owner employees, self-employed individuals, and general partners. This is capped too. There's a double cap there. What this appears to tell us is a couple of things. One, they're not considered employees. They're not going to show up on your Schedule A worksheet, which is important because, especially for owner employees, especially think of like an S-corp context where you're drawing a W-2, this appears to carve these people out of the definition of employees. And I really hope the regulations clear this up because it's a little strange to me. What it also seems to tell me is that they're a totally different category from rank and file employees. So questions are then, I've got, I'm an owner employee. I own an S-corp. I get a W-2. I have an allocable portion of health insurance premiums. I get a match on the K plan. Do I get to include that in payroll costs? The separate line 9 seems to indicate that you can't, and that doesn't make sense to me. But again, if we're taking the most conservative baseline approach and having Foster Swift surprise you with good news instead of bad news, it seems like you don't include that stuff. So that's the bad news. On the other hand, this is incredibly broad, right? So this isn't cash compensation like we see in line 4. It's just amounts paid to these people. Maybe that's enough for owners' draws. Maybe that is enough for guaranteed payments in partnerships. There was some, and we're still unclear on that, but this seems to be hinting that you can include those things as permissible, forgivable PPP expenditures. So keep those things in mind, but also keep in mind this double limit to line 9. One is the $100,000 cap, right? So again, under no circumstances does this exceed $15,385 per person, right? That's a hard cap. The second cap, though, is essentially your self-employment income. Line 31 of Schedule C is what a lot of people are going to look at for this. and annualizing that on an 850 seconds basis for the covered period. You got to take the lower of those. So the lower of 15,385 or 850 seconds of line 31 of Schedule C. Have fun with that math. That's your cap on line 9. So I think that's the only stuff I wanted to point out on this. Everything else seems to just populate over from the worksheet. So now working backwards some more up through the application, we've done the worksheet. It populates over to Schedule A. We got a little work to do in Schedule A on our non-employees, owners, self-employed folks. Bumping up to the application, again, most of the stuff is either verbatim from when you applied for the loan or stuff that's either going to populate from Schedule A or the Schedule A worksheet. A few just quick reminders here as well. Paid or incurred that we talked about earlier. So we know that you can't prepay mortgage interest, but we might have stuff that was, a utility bill that hit right at the start of the covered period for the last month that was outside the covered period. Count it. Paid during the covered period. Absolutely count it. The point there being, you get lines 2 through 4 here, just list everything. Don't worry about the 75% rule. Don't worry about the fact that non-payroll costs can only be a certain percentage of your forgivable expenses. The worksheet does the math for you. List every single expense that you have that falls into this category in 2 through 4. And that makes your substantiation easier, right, too. You're not, doing too much prorations or math or, oh, here's this, that, and the other thing. Just attach the invoice, maybe the canceled check or whatever. But make sure you're packing everything you can into 2 through 4. Even line 1, payroll costs, right? We talked about this at the beginning. If I had a check date that falls on the first day of the covered period for a pay period that predates it, throw it in there, include it, absolutely. Let's see, line 10 is the other thing I wanted to point out here. This is our clarification on the 75% rule. When I read the interim final rule, and I think when a lot of people read the interim final rule, it looked like that 75% test was a cliff. It was an all or nothing test where if you have a $100,000 loan and you don't spend $75,000 on payroll costs, you're in big trouble, right? Because you didn't do what Congress intended you to do. And I think there was a lot of outcry that, hey, this isn't really fair. This should really be a sliding scale. And that's what we have. So now we essentially have a mathematical formula that flips it. Instead of saying that you must spend, thou shalt spend 75% of your loan on payroll costs, we got this different rule that says, well, only 25% of your forgivable amount can be non-payroll costs. And you see how that math works in line 10, right? So we take whatever we spend on payroll costs during the covered period. It might not be the entire amount of our PPP loan. Doesn't matter. We're going to divide it by 0.75, and that's going to give us our maximum forgiveness amount. And what that math essentially does is it caps lines 2 through 4 at 25% of the total forgiveness amount. So you can see how that sliding scale works. It's not an all or nothing. It's just whatever you happen to spend on payroll costs, that's going to be 75% of your maximum forgivable amount, and they might just knock down your utilities or rent or what have you. Again, another very borrower-friendly rule that we're able to glean from this application. And even though Schedule A and the worksheet are a lot of work, by the time you get to the application, it really does all the math for you. So you end up with lines 8, 9, and 10, and essentially whatever the lowest number is your maximum forgiveness amount. So, right now there's some people that are just getting their PPP loans. They're in great shape. For people who are more than halfway through, it's, this isn't the end of the world. What I would recommend you do is take the information you have. You've got some pro forma stuff to do, and do the math, fill out the application, see where you're at.
Great. So last slide here, just to wrap us up. And then we'll try and hit a few questions. We've got kind of a hard stop at 11:15, so we'll fit in some of what we can here. But we wanted to just throw out some kind of practical takeaways, next steps, ideas, thoughts to think through. And I think a lot sort of align with what Mike and I have already been saying here. So again, if you haven't yet, take a ride through the application. It's a ride. It's not the easiest exactly piece of work to read through, but you will be benefited by kind of knowing what's in there, and you'll inevitably have questions. Feel free to let us know if you have questions. We're happy to help. But take a look at it, update, or, if you haven't yet started forecasting, your loan forgiveness amount, yeah, now's the time. I think running those numbers is going to make you, put you in a much better spot. Particularly, I just really, I think if we're coming up on that 1 or 2 weeks out from the end of our, the end of our 8-week period, now is really the time to have a snapshot so that we know what we can do and what we need to do to try to maximize our forgiveness. Make sure we have everything included, and then let's have a discussion about what strategic decisions can we make to bump us up on the forgiveness kind of end of this. Again, start with Schedule A worksheet and work backwards. You're going to be kind of much better off, and the application basically requires it, but keeping that in mind when you go in will just put you in a little more of a user-friendly position. We didn't talk too specifically through the documentation requirements, but there is an entire page in what looks to be about 8-point font to me that talks you through the documentation requirements on the application. So of course you're going to want to have a really clear picture on that and what documentation is going to be required, on one hand, to substantiate your loan forgiveness application, and also, to be keeping, in your own file in case there are additional questions or what have you that are, meet the requirements of the rules here. Last couple items here, I would just note that, you want to watch for revisions to these rules. It's entirely possible that the application will be itself revised. We have seen that on, the initial application to apply for the loan was revised. This could very well be revised in the future. So keep an eye on that. Make sure you have the most updated copy that you're working off of. Very possible, I think we expect, honestly, at this point, to see regulations. It's tough to think that they would rely on the instructions as the final rules on a lot of these issues. So we're waiting still for those regulations and guidance that sort of implements these rules. And that will be another big step once we hear that. And we'll be doing our best to keep you apprised of those issues. And then, watch for legislation as well. There's all sorts of discussion about, extending the 8-week window or dropping 75% down, down to 50%, or, all sorts of options there. And actually there's, from what we're seeing in general and what we're hearing, I think there's a good amount of agreement on both sides of the aisle for some of these changes. Now that's a pretty, long distance away from any actual changes. So don't hold your breath, but something to keep an eye on, especially if you'll have, really for everybody, whether you're just getting the loan or you're nearing the end of the 8-week window. Something to keep an eye on. And lastly here, I think it goes without saying, but, certainly feel free to contact us with any questions. We are absolutely doing our best to respond to every single question that comes into our email inbox. And we'll have our email our email addresses up on the next slide real quick. And we'll be emailing these slides out as well as a recording of the webinar and the last one if you didn't see it. But please feel free to contact us with questions. Please feel free to contact us just to review your loan forgiveness forecast, and as well, reviewing your actual application when it comes time, because that's obviously going to be a huge step as well. So with that, we'll try and hit a few questions here in the minute or two.
And change. Yeah, let me just blow through a couple here. A lot about, do we have, one, apologies about my audio earlier. I hope we got that fixed. I just saw it now. Is this available in a spreadsheet? No, it's only downloadable in PDF. Be wary of the stuff you see online. I've looked at a whole bunch of them to see if I can shortcut it myself. None of them are comprehensive. They don't do the reduction tests, or they don't include safe harbors. So there's not a panacea spreadsheet out there available. You're gonna have to build your own, do your own math. Are bonuses available? Yes, they are, but keep in mind the carve-outs for employee owners and whatnot, and those caps. But yeah, hazard pay and everything, absolutely. Go ahead and pay that stuff. I think that's great. Utilities, we've got clarification that cell phones do count for phones. So you got landlines and cell phones, go ahead and count that. Doesn't seem to count the hardware. So if you've got the actual phones or the tablets, I think that would be a little more of an aggressive approach. Be careful with that. Transportation expenses is still ambiguous. Our self-employment rules state that it does include fuel expenses. It does include stuff like oil changes. Those are only in self-employment rules. Do those continue on to the regular business rules? We do not know. So keep those in your back pocket, but don't go relying upon them. Maybe it's an extra little bump for you at the end. What else? Health, retirement plan stuff. If you've got a discretionary employer contribution and your plan says that you're obligated to make it based on a certain formula, or it says you have the discretion to make it and doesn't prescribe thou shalt pay it on this date, you've got discretion to pay it. I think you can pay that during the covered period as long as your plan gives you that discretion. But check with your employee benefits plan person, like Mindy Johnson, to see if your plan gives you that flexibility to do that. Absolutely go ahead and pay that if you've got the discretion to do so. Let's see, we're a minute over and we've got another 119 questions to get through. I hope that covered a bit of it for you guys. A couple other notes, I guess. There's a lot of permitted expenses here and we covered a lot of that in the last webinar. So please take a look at that. Stuff like, leases on tangible personal property, leases to related party owners. I think those are all fine, subject to certain caveats. So those are our email addresses. You can look us up online and you get our phone numbers too. Please contact us with your questions. We really appreciate you guys sticking around. A ton of people have stuck around over. So thank you for that. Taylor, I'll turn it over to you for any closing comments you've got.
No, I think, again, just, keep an eye on how this develops. Please absolutely feel free to reach out. We're doing our best to help here. It's this certainly wasn't an update that make things simpler. And, we hope it didn't, it isn't too complicated, but at the same time, feel free to reach out. We know that there's a lot of clarification needed and just, we're doing our best to track that. So if you do have any questions, we're certainly available. And thanks for attending. We received just really kind feedback and really appreciate it. So have a good day, everybody, and you'll be hearing from us soon.